Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan and Adrian, here as always with Adrian Nicholson. Adrian, how are you doing? I was glad to be back. Have another great episode planned. How's your last couple of weeks, man?
Yeah, the last couple of weeks have been great, Roshan. I'm excited to be here on the podcast today. I'm looking forward to our topic today. One of our colleagues, too, is really looking forward to this topic because they're the one that recommended this article to us. So I'm really excited to dive into it with you today.
Yeah, I think this is going to be an interesting one. We had our colleague, Bob Fratkin, who sent us a Morningstar article. And the article is called 10 Financial Rules of Thumb You Don't Have to Follow by Amelia Fredlich.
First one is something that we've probably talked about a number of times on this podcast. The first rule is delay Social Security as long as possible. How do you want to take on this one first, Roshan?
So when we approach Social Security, we look at it. I guess I'm going to probably be saying this for all these rules of thumb, but we always look at your financial plan to figure out what makes the most sense. For people who are listening, these are general rules, not advice at all, and we would highly encourage you to have a financial plan. If you need help with your plan or building one, please reach out to us. We calculate Social Security, one, based on what would be the best in terms of what you'd get from the system, and two, what would be the best on your financial plan. So we look at those two things to get you, which really gets away from the rule of thumb and gets you into specific decision making for your goals. But that's our approach. Now in the article, she had said follow the rule is if you're working or if delaying it could be a good motivator. And she had said that you break this rule when you don't have a long life expectancy, which I've definitely seen with a client of mine before where, she suffered cancer in the past, so she started it early thinking she won't live that long. The other reason she says to break the rule is if you can't work till 70 and you don't have retirement assets that will get you to 70 where you could start Social Security. And the third rule is when your spouse earns more than you, eventually when your spouse passes away, the Social Security you get bumped up to what the higher spouse earned at the time, assuming the one with the higher Social Security isn't expected to live as long. So those are her general rules. I would just say calculating it and figuring out what fits your personal financial situation makes the most sense in my mind to see when you should really select it.
Yeah, I definitely agree with all those points. And just taking them as a rule of thumbs, it just makes sense why delay Social Security as long as possible is on this list. But then you really got to apply it to your situation. And one of the things that people say, hey, this isn't really a good rule delaying Social Security is because maybe my life expectancy isn't that far out. So I want to take it as soon as possible to get that benefit. So those are all great points, and I'm really looking forward to continuing this discussion on to the next one, which is never take a loan from your 401k. And I can start off with this one. This is a really interesting one that I was surprised that was on the list. So never take a loan from your 401k. I think this is a good rule to follow, especially if you have emergency funds saved up that can cover an unexpected expense that arises. It makes sense for you to finally put that emergency fund to good use other than withdrawing it from the 401k. And the opposite side of that, on a reason why you would probably never want to take a loan from your 401k, is because let's just say you're somebody, if you have a high interest rate debt, maybe this could be an option for you where, hey, I might incur some expenses and a penalty by getting a loan from my 401k, but it's worth it because I ran the numbers and getting this high interest debt paid off could be very beneficial. So those are the two ends that I wanted to touch on for this rule of thumb.
Yeah, I'll make one note on the high interest rate debt. I completely agree with what you said, with the caveat that make sure you don't charge it back up, right? We've seen, I've definitely seen people like this where they get a loan like their 401k to pay off their credit card debt. Then they charge their credit card debt, and now they've got the credit card loan and the 401k loan, right? The credit card debt and the 401k loan. The other thing that she mentioned is similar to credit card debt is is that you have another loan with a high interest rate, a third party loan. Uh, and she had said also if there's a specific one-time need that you need, and she mentions preventing an eviction or foreclosure as those one-time needs. I also have would argue that if you were able to use it for a new home, that may be worthwhile. I say may, not necessarily it is, not making uh, this one of the bullet points she has. I wonder if that's why she didn't include it, because it's not all scenarios where it makes sense. But there's some 401k plans which will offer you long-term loans for down payments for your home, like 15-year type loans, where it might make sense to do that to get into a home. But the general rule of thumb of you don't want to take loans from your 401k, I agree with. And with the new home, I want to add one other point, because I've just seen this recently with somebody. If you are going to use it for that new home piece that I mentioned, you have to make sure you calculate the loan payments to your 401k when you're looking at your total cost of ownership for that new home, because that will definitely negatively impact your cash flow. So you've got to make sure the numbers all make sense and run the calculations.
Yeah, that's exactly what I was trying to address earlier, where you have to outweigh the cost and you have to run the numbers here because it can make a difference on your long-term plan or on the short-term aspect as well with this, because again, there's penalties, there's interest involved in it. So you want to make the best possible move by running the numbers and making a decision on that. So
Yeah.
thanks for pointing that out, Roshan. The next one on the list is prioritize paying down your mortgage. How would you handle this one, Roshan?
What's interesting is if you asked me to guess the rules of thumb that you had, the 10 before we started looking into it, I would not have expected this on there at all, just because the general financial planning rules of thumb that I've seen have been that you can typically earn more in interest than your cost for your mortgage. And that may have changed now that mortgage rates are so high. You also get a tax deduction for the mortgage, which you don't get for other types of debt. So I was surprised to see this. Now, her reasons of when to follow it um, were you're close to retirement, so so you may not earn as much as your on your interest versus the cost of the mortgage. I once again see if this were a realistic scenario, this could make sense, but you've got to look at the specific situation. Her other situation, when to follow it, makes a little more sense to me. When you have less than 20% equity in your home and you've got mortgage insurance, then you've got to look at what that cost is. I try to calculate it and look at what your true cost of capital is in that scenario. Her reasons to break it are really what the general rule of having a mortgage that I would have expected are. One is your mortgage interest rate. This says is lower than bonds or cash yields. I would always compare that to longer term investments and on an after tax basis. Her next point is you have longer until retirement. Uh, so if you're looking at a long-term time frame, stock investing will outperform the mortgage rates over several decades, is how she puts it. And the last one of when to break it is carrying a mortgage can be a boon to your taxes because you get the tax deduction for the interest. So uh, I'd say I've almost seen this flip the other way normally, where it's when should you? Her rule of thumb is prioritizing paying down your mortgage. I think the rule of thumb I've generally seen is when to not pay down your mortgage as the rule, or not paying down your mortgage, accelerating your mortgage payments being the rule, and her reasons to follow it being the exceptions.
Mm-hmm. Yeah, I mean, this is another calculation rule of thumb if you really think about it. It really just
Yeah.
depends on what rate is on the mortgage right now. And then I can't see how this has been a common rule of thumb over time just because a mortgage is just a big part of somebody's expenses and their monthly budget. So prioritizing paying that off or paying that down over time is just very beneficial because one less expense you have to worry about can really simplify your plan and make you focus on what's the next thing that you can pay off. So I guess that would be my take on that one.
Agree with you on that, but the other side of it is, and this goes back to what I warn the listeners I'd be saying frequently, is looking at your financial plan. Like if you're
Hmm.
someone that's got a pension in retirement and you're going to have taxable income, or if you're someone that has um, will have required minimum distributions that are significantly greater than your needs, from having these big 401k or TSPs, IRAs. Those are scenarios where having a mortgage and having that tax deduction will be worthwhile. So I would almost say this might be one of the more controversial ones, just because it's as you said, Adrian, requires a calculation. But what I've seen the default being is don't pay your mortgage down earlier, where she has the rule of thumb being pay your mortgage down, uh, and I view it as paying it down at an accelerated rate.
Mm. I mean, that's a good point. I feel like we should just have our own separate podcast on this. I mean, all of these could probably be their own episode. If you're a viewer or listener right now and you're like, hey, I really want you to expand more on it, please reach out to us or just let us know, and we'll be happy to just expand on that further. So, moving on to the next
Yeah.
one, and I'll start off with this one. It's prioritize diversification and investing. And I think this is a great rule of thumb. Diversification can really help you handle the ups and downs that come your way via the market and the economy. So this is definitely a rule of thumb that I like. And where I could see you probably break away from this rule of thumb, where you move away from diversification, is if, let's just say, you're over diversified, or you have a number of positions and investments that you have to manage, and that can really be a lot for somebody and really eat away at performance. Yes, you're diversified, but maybe over diversifying in this case is something that you shouldn't prioritize.
Yeah, and I've always heard the term that concentration creates wealth and diversification maintains it. Right. So
Mm-hmm.
where you are in your investing life, what your risk tolerance is, what your time frame is, all these things will feed into this. So and you'll see famous investors, and I don't want to misquote Munger, but Charlie Munger said something to the effect of diversification is he was not the fan of diversification. He would call it diversification, and he has said stuff like uh it's showing that you haven't done the homework or something like that before. And uh, it, it says, here's a Buffett quote: diversification is protection against ignorance. It makes little sense if you know what you're doing. Right. So I think the reader assessing the reader of our article, the listener to our podcast, needs to assess where they are with their investment expertise and knowledge base, their risk tolerance, their time frame. They need to look at all these things to figure out where this fits in. I find this is interesting because she has rules on when to break it, and I'm just surprised to see that in this type of article, just because I would normally expect to see that diversification wouldn't have times that you break it in this article. Her um, rationale for following the rules is shorter time periods, where if you're looking at something that's 6 months, a year out, maybe you don't want to diversify, maybe you just want to get CDs, that kind of thing. um, or if you're only investing in single stocks, you'd want to make sure you're diversified. And those are when you follow the rule, and when you don't follow it. And actually, what's interesting is I took her short time period as when you don't follow it, thinking you'd be concentrated in like a CD, but this is actually her argument uh, for prioritizing diversification. Her arguments for when you don't uh, follow it is that she says you've been taking the same approach to diversification for a while. Correlation between asset classes change. One mix of investments may not be the same for every market environment. So I guess she's saying you break it during various market environments, but uh, I wonder who's listening that's going to know when that market environment changes. She says then next you're adding asset class that don't serve a purpose. I wouldn't disagree with that. If you're adding an asset class that isn't diversifying you, and you don't like it purely on its own investment merits, it doesn't fit in. And then she says when it's getting too complicated, and that Morningstar's research shows that 87% of the time a 60-40 portfolio, 60% stocks, 40% bonds, has better risk adjusted returns than being exposed to all 11 asset classes. So she's saying that's when you break the diversification rule. But I think you can make a strong argument that a 60-40 portfolio is diversified. So um, I don't know that I would view this bullet point in a totally different perspective than she did, with what is diversification and what isn't. As I said, I think the 60-40 rule portfolio you could say is diversified, where she's, from her perspective, saying it's not. So I'd want some more detail from her, which I don't think fits in the article. I think that's a conversation to understand her perspective on that bullet point.
And I think you need a lot of detail when it comes to pretty much all of these. I mean, when it comes to financial rules, especially from people like us, Roshan, we know that there's levels to it. There's individual situations that are different to it. So just having financial rule of thumbs, I guess like the whole message of really this podcast of what we're trying to say is, yes, sometimes they're great. They can work out. They can be helpful ways of pointing in the right direction and make decisions. But you also have to be aware of the opposite side of it, where sometimes they won't work out into your favor, or sometimes you need to dig a little bit deeper just so that efficiency really pays off in your life.
Yeah, and I'm not. This could be just a function of what we do, but I'm not a fan of rules of thumb. I'm a fan of getting a plan in place and figure out what applies. But I also would say, um, beyond the world of finance, I'm not necessarily a fan of rules of thumb either. So uh, I think you've got to figure out what works for you individually and what makes sense for your case, not just in the finance world, but in all walks of life.
Yeah, great point. So we can move on to the next one. I'll let you start off with this one. This is a common one that you hear all the time and and hear about: buy the dip.
Yeah, and once again, not a fan of this rule of thumb, right? And the reason I'd say that is I don't think you buy the dip just to buy the dip, right? There are, uh, if something's gone down and you believe in it, and you've looked at your analysis and confirmed that you feel comfortable with it, then you buy more, right? But just arbitrarily buying the dip because there is a dip doesn't make sense to me. I'm surprised that you would call that a rule of thumb. Period.
Yeah, well, I just think of it just buy low, sell high. I mean, that's a common one that people hear. But again, that's easier said than done, because that sometimes plays into timing, what investments you're looking on. So it's a saying, it's a rule of thumb that can be very beneficial and be very profitable. But to actually do it and be realistic about it is a whole nother story.
Yeah, yeah, I see what you're saying, but like, to me, buying the dip means you buy something when it went down or because it went down. And there are definitely cases where the dip happens for a good reason, and you should be selling into it because it'll go down further versus buying into it, right?
Mhm.
So this is, to me, too broad to actually be a helpful piece, and I'm surprised to see this as a rule of thumb as well.
Mhm. Excellent. So the next one we have on our list, next rule of thumb is called withdraw no more than 4% annually from your retirement portfolio. And this is sometimes known as the 4% withdrawal rule. And this can be helpful for keeping a stable and consistent cash flow throughout your life without maximizing and withdrawing all of your portfolio. This helps gives your investments room to grow. But on the counter to this, I would say would be the retirement smile, would hate the 4% rule, because the retirement smile says once you retire, your spending is going to be at a higher level because you might be going on trips, just spending more, just a new adjustment in your lifestyle where you're getting your expenses in check. And over time, that will kind of go off a little bit more, where your expenses will be a little bit more constant. But then as you go on further in life, you might run into more costs, whether it's gifting, healthcare costs, whatever, where this 4% rule really wouldn't apply to you because that just wouldn't be something realistic in your lifestyle at that moment.
Yeah, and this is definitely one of those where, as I warned, I'd be saying build your financial plan to figure out what you can, should, and need to withdraw. You need to withdraw based on your expenses, what you can withdraw based on your portfolio, and what you should withdraw with both of those things in mind, right? In some cases, if you've got an excess and it's in 401ks, you should withdraw what your minimum distribution is, whether even if you need less, because if you don't, you get hit with a hefty tax penalty. So, and this is one I've heard talked about for years, this 4% rule, but I love your comparison, Adrian, to the retirement smile, where you're taking more money out earlier and more money out later, because that 4% rule would not work in that scenario.
Yeah, and I think it's just a good way just to look at it. Where again, it's a good rule of thumb. Only withdraw 4% because, like I mentioned, you want to have your portfolio grow as much as it can, while also using those funds to support your lifestyle. But depending on what your situation is, that can put a real guardrail on whatever your expenses are, and that, as we know, sometimes just doesn't work out for people's situation. So moving on to the next one, and I'll let you start off with this one. It's called Maximize Matching Contributions to Your Employer's Retirement Savings Plan.
Yeah, and this one I agree with the rule of thumb. I want to go into the options when she says to break it, and just discuss those. So maximizing your matching contributions means you're contributing to your 401k or TSP, 403b to get the full match the employer offers. And she is saying you break it potentially when you have high interest rate debt. I don't disagree with her here on this, but I'd want more information. And this is where I think the individual's financial plan and position and situation does apply, because I also think there are times where you have high interest rate debt and you'll still want to maximize the employer contribution, particularly if you'd be able to pay it off, within the next year or so, at your current rate, while maximizing the 401k. Her other reason is you don't have an adequate emergency fund. Um, I can see her perspective on both of these, high interest rate debt and an emergency fund, but you really got to look at that individual situation. I hate that I'm saying that so often, but with the emergency fund in mind, if you don't do the 401k to the match, you're giving up 100% return. Right. So not having an emergency fund, the risk there is it can lead you to credit card debt. And so we've got to balance that risk of, well, what if you go in credit card debt um, with giving up the 100% in quotes rate of return that you get on your money when you get the employer match. So I understand what her reasons for saying when you should break it, but I would think long and hard before you give up that match.
Yeah, and it just goes into prioritizing as well, because you just want to see in the hierarchy performance on which one should I really do first, what type of investor or individual I am, what matters to me the most, and that also can really sometimes supersede any calculations that you run. I mean, I'm sure you've probably seen all the time where the data points one direction, but somebody just goes in the other one because, again, that's just something that they're comfortable with or they want to do.
Yeah, with that Social Security one, I definitely have had clients who have said that they want to take it earlier than the numbers dictate or than conventionally make sense for a variety of reasons. And, there's uh, no convincing them otherwise. So you just balance the rest of the financial plan against their decision to take it earlier.
Mm-hmm. Yep. So moving on to the next one, prioritize hedges against inflation. This is another good rule that I like a lot because that's something that we have been dealing with recently. And this is somewhere where you need to think about what investments are going to help maintain your standard of living, ensuring that your savings and your investments can meet your future expenses, whatever that may be, whether it's housing, healthcare, or your everyday expenses. Are your investments, is your portfolio keeping pace with inflation? As we know, some investments are good at that. Some get impacted with rising inflation. So this is something that you really have to weigh too. And with this comes opportunity cost, because you might find a good investment out there that can keep pace with inflation and beat it. However, there are other investments that might perform better, and that's something that you really have to weigh when you have to make this decision on prioritizing hedges against inflation.
Yeah, I'm surprised this is a rule just because I don't know people that generally think about hedging against inflation as one of their goals, right? It's more about growing the portfolio. Not saying that they shouldn't, just that I don't really see that. Whereas some of the other ones, I see and hear people talk about them as general rules. But what she's saying here makes sense that if in short term you need your money, or if it's more of a bond heavy portfolio, which may be the case more for people who are retirees, this makes sense. And it doesn't make sense to be as concerned when you've got more of a longer term time horizon with a stock heavy portfolio.
Yeah, I mean, those are all points I agree with. It really does depend on the investments that you're in and what other opportunities are out there. So, moving on to the next one. And this one I like a lot because I've never read about it or heard about this before. It says hold 100 minus your age in stocks. And I'll let you start off with this one, Roshan.
Yeah, I have definitely heard this one before frequently, Adrian, and I'm not a fan of this, right? Just thinking of I understand the concept. The concept is if you're 20 years old and you take 100 minus your age of 20, and that says you should have 80% in stocks. And if you're 50 years old, you take 100 minus your age of 50, you have 50% in stocks. And if you're 80 years old, 100 minus 80 is 20. You have 20% of your money in stocks. The reason I'm not a fan of this, and I really never have been, is if you're a 20-year-old and you have a very conservative nature, you might not want 80% of your money in stocks. And if you're an 80-year-old with excess wealth, you'll be passing a lot on to your heirs. You probably are negligent to the portfolio if you have only 20% in stocks, just because it's not invested for your lifetime. It could be a multi-generational investment that could span like 100 years. So I understand the rule, but I defer more to the when to break it scenarios versus when to follow it. Her reasons to follow it are if you want to keep investments simple, and if you need a nudge to rebalance the portfolio.
Yeah, I think that rebalance is key here for the hold 100 minus your age in stocks. I think that's the overall theme for this rule of thumb, where let's just take your example of that 20-year-old who just built a portfolio off this rule of thumb, and they have 80 different stocks out there, and they're very over diversified, and it works out with them for the first year. But I think this rule of thumb is a way for you to come back and look at your portfolio, rebalance, constantly check in on it just to see, hey, am I the same investor I was when I first set up this portfolio? Because if you set it and forget it, it might be different the next time you look with it, where you're not comfortable with the level of risk you're on, or maybe you want to change that as well. So I think this is a good way for you just to check in, just to see if your investments really reflect who you are as an investor.
Yeah, see, and I feel like wouldn't the better rule of thumb to be to rebalance your portfolio
I mean,
annually?
it's not as
Yeah,
catchy
something like
as
that.
hold 100 minus your age in stock. But I think it's just a clever way of just saying, think about who you are as an individual too, because your age is personal to you. So I think that's where I think this rule of thumb can be beneficial, where people do the calculation in their head and then look at their portfolio, where you just have a rule of thumb that says rebalance your portfolio. That doesn't give you as much information as this one.
Maybe. I guess my argument with this one is this good information. Rebalance your portfolio following this guideline versus rebalance the portfolio you constructed based on multiple different factors. Maybe that's what I'm getting at. But maybe to your point, rebalancing it um, at all may be better than not rebalancing it. So I can see why, but yeah, that's kind of my challenge. I guess not liking the rule to start with is making me not like not see the value as much. But I guess in the absence of anything better, this is something to use.
Yeah, I'm glad you added that. And we can move on to the last one, which is retirement is the end of work. What was your initial opinion of that, Roshan?
I, everyone's retirement is very different, right? So uh, I definitely have people that retire and don't go back to work. I have others that'll retire and start a business, others that'll retire and stop working for compensation, but will volunteer at, a similar, full-time basis as when they were working. So everyone's retirement really is different. So that's where with this one, I'm not sure. Um, uh, I lean more to the when to break it group than when to follow it group for her.
Yeah, and I think it's what your definition of work really is at that point too, because like you said, like retirement is different for everybody, but as time goes on, your definition of work may be different. Where in the article mentions turn your hobby into a work, because having that structure can sometimes be beneficial for people out there. So that's also just something for our viewers and listeners to just consider.
Yeah, yep, it is. And what is that retirement? What does retirement mean to you, right? And
Yes.
if to you it means the end of work, so that's great. If for you retirement means you move on to do other things that fill up your time or would be considered work that you wanted to do, if that what makes the enjoyable retirement for you, that's the path you've got to follow.
And how you want to spend your time ultimately, that's something too that we talked about is vital to plan, not planning all the numbers, which we were just talking about in the beginning of this podcast, running the plan, but ultimately, how do you want to spend your time? What does your lifestyle look like in the future? Can be just as vital as what the numbers look like.
Yeah, I completely agree. It's an interesting article. I liked reviewing the rules of thumb and going agreeing with some, disagreeing with others, but overall I think it was a good article, a good read. I hope our uh, analysis and additional information to it was helpful to everyone. We'll be back next week with another great episode, or in 2 weeks, excuse me, with another great episode of the Retirement Lifestyle Show. Please like, subscribe, give us 5 stars, take control, and achieve your goals.
Schedule a conversation with Roshan, Adrian, or Eric today at retirementlifestyleshow.com. Roshan and Eric are certified financial planner practitioners. They, along with Adrian, are investment advisor representatives and serve clients across the U.S. with financial planning and investment advice through Arete Wealth. If you found this show helpful, gained knowledge, or enjoyed the time you spent with us, tell your friends and leave us a 5-star review. This will help others discover the show. To access our show notes, to download any of the tools mentioned in today's podcast, to ask us a question, or to schedule a conversation, go to retirementlifestyleshow.com. All opinions expressed by podcast hosts and guests are solely their own. While based on information they believe is reliable, neither Arete Wealth nor its affiliates warrants its completeness or accuracy, nor do their opinions reflect the opinion of Arete Wealth. This podcast is for general informational purposes only and should not be regarded as specific advice or recommendations for any individual. Before making any decisions, consult a professional. The show hosts offer investment advice through Arete Wealth Advisors, LLC, an SEC-registered investment advisor, and securities through Arete Wealth Management, LLC, member FINRA, SIPC, and NFA. Finally, our music is The Chance by Jason Shaw and Audionautics. It's part of the YouTube audio library, and it's licensed under a Creative Commons license. I am Ray Voices. Thank you for listening.